Most new traders hit a margin call in the first year, and it is not because the market is out to get them. It's the same avoidable mistakes just happening on repeat. Have you ever watched your account turn red and felt helpless as trades vanished? You're not alone. In this video, we'll go over 10 common traps that quietly wreck accounts. Stick around, because just one of these tips could save you a lot of money. Starting with $100 and jumping straight into 1 to 500 leverage, it sounds like a shortcut to big gains, but really it's more like lighting a fuse. Just a small price swing and suddenly your entire account is wiped out. Leverage can boost profits, sure, but it also leaves you with zero room for error. If you're serious about trading, don't treat leverage like a lottery ticket. The best traders focus on staying in the game first. Survival comes before profits every single time. Skipping a stop loss? That's like driving without brakes and hoping the road stays clear. Everything might look good until a surprise move flips the script. Suddenly, you're holding on, waiting for a bounce that never comes. And then comes the ping, the margin call. A lot of traders skip stops, thinking their analysis will carry them through. But in forex, nothing is guaranteed. Without a stop loss, you're leaving your fate up to the market, and trust me, it will not always be kind. Your trade is in red. What do? Instead of cutting the loss, you double down, hoping a reversal saves the day. But the market keeps dropping, so you add again and again until your account is done for. It feels like you're managing the trade, but really you are just throwing good money after bad. Here's why this trap is brutal. You are compounding the risk on a losing idea. The market doesn't owe you a bounce, and your margin won't wait around. Smart traders know when to step away. Adding to a loser isn't a strategy, it is a slow account killer. You see a big move and feel the rush. You hit buy without a second thought. Or maybe you just took a loss and want to win it back fast. Sound familiar? That's how emotional trading gets you. One bad entry turns into a chain of poor decisions, and suddenly you're staring at a margin call. Emotional trading usually shows up in two ways. First is FOMO. This is where you jump into trades without a plan because you're scared to miss out. And the second one is revenge trading, which is where you try to force a win after a loss and usually end up making it worse. The market doesn't respond to hope or frustration, it moves on its own terms. And if you can't keep emotions in check, you'll keep trading your account into the ground. The pros, well, they trade the plan, not the feeling. Just because the market is open doesn't mean it is moving. One of the biggest mistakes, especially among new traders, is jumping in during slow sessions when nothing is really happening. And if you're trading from regions like Iran, you might be active during the quietest hours without even realizing it. But why does bad timing hurt so much? Well, you have wider spreads in low volume hours that can eat your profits before the trade even breathes. Low liquidity opens the door to fake outs and choppy price action as well. Stagnant trades can sit in the red way longer than expected, sometimes even for days. Smart traders wait for volume, volatility, and clean setups. If you're not sure when to trade, sometimes the best move is to trade not at all. You've got $1,000 and risk half of it on one trade. It dips a little and suddenly you have lost 500. So you go bigger on the next one to make it back, and just like that your account is toast. That's what happens when there is no money management. You see, good trading isn't just about picking the right direction. It is about protecting what you've got. Here's why this trap is deadly. Over-risking means one bad trade can wipe out weeks of gains. Experienced traders always know how much they're willing to lose before they even enter. Without a risk plan, even the best setups can fail you. Managing money isn't optional, it is survival. One of the easiest ways to burn your account is following someone else's trade signals without understanding what you're getting into. It feels safe. They must know what they're doing, you think, but when the trade tanks, guess who's left holding the loss? You. Here's why it backfires. You don't know the thought process behind the signal, or if there even was one. A great entry still needs your risk management and exit plan. A lot of signal sellers are more interested in followers than your success. No trader makes it by copying without thinking. If you're trusting someone else with your trades, make sure you're still in control, because no one is covering your losses but you. In forex, more isn't always better. A solid win feels good, but chasing huge wins without every trade, well, that's how accounts disappear. The difference between a trader and a gambler: a trader knows when to take profit. A gambler hangs on and usually gives it all back. But greed wrecks accounts in different ways. You hold winners too long, you hope for more, and then they reverse. You size up trades way beyond your comfort zone, chasing a jackpot. You ignore steady gains because you're hooked on the idea of a big score. The market doesn't reward wishful thinking, it rewards discipline. If you can't decide when enough is enough, the market will decide for you. Let's be honest, trying to flip $50 into 10,000 in forex is a recipe for burnout. With tiny capital, you're forced to lean on heavy leverage, take oversized risks, and hope luck covers your gaps. Most times, one unexpected move and you're out. So here's why trading small stacks is so risky. First of all, high leverage becomes your only option, and it's unforgiving. One modest loss can wipe out your entire balance. There's no room for strategy or patience when every trade feels like life or death. Forex isn't about luck or miracles, it is about longevity. And without enough capital, survival becomes your biggest challenge. So, you're mid-trade, the market turns, and suddenly your position is closed and your account is nearly empty. What just happened? A margin call. And for a lot of traders, it is a total mystery. Too many jump into forex without fully understanding how margin, leverage, or stop out levels work. And when things go south, they are caught off guard, confused, frustrated, and broke. And here's why this is such a silent killer. You unknowingly over-risk and drain your usable margin. You don't know how your broker's stop-out levels work, so you assume there's more room than there is. And when your margin level drops too far, trades close automatically, and there's no undo button. Trading without knowing these basics is like flying blind. If you don't learn how margin works, you won't just lose a trade, you will lose your entire account without even seeing it coming. Do you recognize yourself in any of these traps? Well, if you do, you're not alone. We've all been there. Share your story in the comments, drop it down there, especially the one that hit the hardest. And if you've got a trading buddy making these same mistakes, send this their way, because it just might be the wake-up call they need. Thanks for watching. Until next time, trade smart and protect that capital. Goodbye.